Good morning, members. We all have gathered here for a breakfast meeting on this Saturday morning on the topic AQMM. And to dwell upon this subject, we have CA Jaideep Trasi, sir. May I call upon CA Govind Bhatt, sir, to escort the speaker onto dais and then welcome him with the floral bouquet. Thank you, sir. I have privilege in introducing today's speaker, Jaideep Trasi. Jaideep has more than 21 years of professional experience working in one of the India's largest audit firms in various states, various roles, including that of an audit partner. His experience includes services such as statutory audits, internal audits, equity listing engagements, due diligence reviews, and special agreed upon procedure and review engagements. His exposure included entities from manufacturing, engineering and automotive, food processing, consumer durables, healthcare, software technology and related services, trading and infrastructure companies, as well as auditing through shared services, global in-house centers. He has, during his previous experience, interacted and worked with teams in other geographies on audit practices and quality compliances, and also developed core competencies to audit under various accounting guidelines, Ind AS, IGAAP, IFRS and US GAAP. He, along with certain colleagues, has decided to use this experience to others in the profession and is a part of a team which is the first to offer quality as a service to audit firms. He has facilitated various trainings on audit methodologies, understanding controls and testing, speaking and presentation skills, etc. He is a chartered accountant from SAI and also a Bachelor of Business Management from Bangalore University. With this brief introduction, I present before you CA Jaideep, sir. Over to you, sir.
Thanks. So good morning to everyone. Now the topic that we are covering is audit quality, and most importantly the term after that is maturity model. The name itself quite clearly specifies that audit quality is not a destination but a journey, and therefore there is a constant evaluation as to how audit quality matures, and this is a model that establishes how do you check the maturity of the model. And therefore clearly when I start taking you through the core areas of the model that the institute has put forth, it will indicate that this is a self-evaluation process and for you to establish a journey in audit quality. So what we will be covering as we go through this is the current status of how audits are, the regulators' market expectations as they stand, and what then finally is the requirements under this model. I'm sure what you are seeing there is nothing new. This all started first, in 2001 when the Enron scandal happened. It resulted in the dissipation of one of the largest, not one, it was the largest existing multinational global audit practice, Arthur Andersen's. It was completely diminished, destroyed purely from that one scandal. Then you had the Lehman Brothers, 2008, again nothing new. This talk of global depression and whatnot started in 2008. Globally again, just because all housing loans suddenly became houses on the balance sheets of all the financial advisors. So this was another big scandal that took place. And of course, very year after that, nothing new to India, was the Satyam issue. All these three, kind of facilitated, if you try to look at what the impacts were, all of them with regard to accounting loopholes. Key observation, auditors did not find out what was happening. Whether it's be because it was not the entity that they were auditing, but at the subsidiaries that were not within the scope. These are, however, whatever safeguards the auditor may take, but end of the day, for a stakeholder, when they look at an audit report, their concern is the name that is there on the top and left or right hand corner of the audit report, the firm that is signing off. They are not so carried away or bothered with the other matter paragraph where you are saying so much of revenue, so much of profit not audited by me by somebody else. That's not what a shareholder looks at. Shareholder only looks at whose letterhead is this audit report. First paragraph is opinion. Is the opinion clean? So if these two, that is the letterhead on top and the opinion is clean, nobody really goes through all the other elements that are there in the report, especially the other matter paragraph which comes at the end of the report. So that was the key things that came out here. So what happened? This resulted in the issuance of Sarbanes-Oxley. That was the key biggest amendment that happened in 2001. Followed up, of course, India is the other person that complies similar to Sarbanes-Oxley, which is the IFCOFAR reporting that we have here. So India is one of the few countries that actually reports on controls. More importantly, in India, it's not restricted to listed companies as the way it is across the globe. In India, it's expanded to nearly all companies except for a few private companies which get exempted. That will limits established in such a manner that there is a very few community of companies that actually get exempted from IFCOFAR reporting. So then what happened in 2008, Lehman Brothers, again the same thing. Distinguishment of how the loan should be looked at, whether sales were getting disguised as different forms, again all accounting loopholes. Again the concern, auditors are not able to find out what's happening. Result of this, international standards started getting converted to IFRS standards. So the international accounting, the IAS became IFRS, and IFRS 1, 2, 3 started coming up, mostly with the intention to fix the loopholes that were otherwise existing within the accounting standards. So now if you look at the impact, which is the converged Ind AS that we have here, when you moved from AS to Ind AS, whether it be in 2016, 2017, whichever was the conversion date that was looked at from a comparables perspective, the annual accounts moved from a 10, 12 page report to a 30, 35 page report. Key reason, the amount of information that you are expected to disclose into the financial statements considerably changed. More so now with the current revision that happened in Ind AS 1 from significant accounting policies to material accounting policy information. Amount of information to be disclosed is going to go up further. So that was one of the key changes. Was it restricted to that? No. This also resulted in a change in the auditing standards. The revised SA 700, 701, 705 came up with revisions. 701 clearly bringing out key audit matters, or critical audit matters as it changes between UK, Europe, or US. So, but the concept of CAM remains the same. Anything that requires additional focus or effort from the auditor needs to be disclosed, not just the matter, but what was the audit procedure actually followed up by the auditor to address that matter. Intention was to make more information available to stakeholders. 2009, yes, one of the biggest impacts that this scandal had on us was the entire Companies Act underwent a revision. The intention with which the Companies Act revision commenced, so it came out finally in 2013, that's because of the amount of amendments it underwent. The bill came out in 2010. Then it went on to bill 2011, when it became a bill of 2012, finally became the Act in 2013. But the intention for change in the Act came from the Satyam scandal. And how could something this big happen in India and no auditor found out? It was, of course, all reasons as to why the auditor did not find out, there are plenty. Because when a fraud is done intentionally, it's very difficult for an auditor to find. And I agree that from an auditing standard perspective, it's not the duty of the auditor to sit and find frauds. And we'll try and see what the NFRA chairperson's concerns was when he said no. You have to still find it because there's a standard which requires auditors to consider fraud when they plan their procedures. Which means, though you may not be looking for identifying frauds, you have to evaluate probability of a fraud may exist and see whether any procedures need to be adopted into the purpose of confirming that they aren't in. So these are fraud risk factors evaluation, which is a requirement under the auditing standards. So these things came in mostly out of these scandals. And therefore, there was a significant change in the overall regulatory landscape. There were new auditing standards, there were new accounting standards, there were new governance regulations that were coming in. Whether in India it came in, whether SEBI came out with new governance standards, which even now are undergoing changes, and what the role of independent directors and audit committee is. There were more and more committees being formed within the institute itself. You had not just the peer review board coming in, you had the quality review board coming in, then you have the FRRB coming in, now the NFRA also looking at it. So when you look at all of these committees that are being formed, all of them are looking at what? The bottom line here that everybody is evaluating is audit quality. At most, I may extend it to say financial reporting quality. because FRLB is looking not just how the auditors are cleared it, but how the company is also doing it. And therefore they can communicate to both the CFO as well as the engagement partner to say what were the gaps that they observed as part of their review. But everything else is auditor centric. The peer review is looking at the auditor, the QRB is looking at the auditor, the NFRA which was formed is looking at the auditor. And all of them are looking at the same thing. Have you complied with the auditing standards? So they're not deviating from what is required. And within the auditing standards, when you start looking at the SQC, Standard on Audit Quality, that refers to your code of ethics compliance. So your code, your standards on quality, your overall auditing standards, all of that is all that these committees are looking at. Now we have 4 different parties looking at how have you ensured compliance, not one. So what is happening? This was of course a little more than a year back. The past president made a statement which caught everybody's eye. And this is a very concerning statement because he has said audit is serious business. Stay away if you cannot meet the expectation. Which means just because you have a CA certificate, you have a COP, does not mean you can go ahead and start signing financial statements. Because it's a serious business. If you do not have the necessary skill sets, if you do not have the capacity, and when I say capacity, it's not your capability. There's a difference between competency, capability, and capacity. And these are 3 critical factors. If you guys have, remember your ISA 620, it's an evaluation you do when you rely on an external expert. So these evaluations you have to do for yourself also before you start practice, especially in the field of audit, because the requirements are significant. So what do you talk about expectation gap? What was he referring to when he said if you cannot bridge the gap? Is the gap something new? Is it something that came now? No. This has started years ago, decades ago. First discussion of expectation gap came in 1978. There was a commission that was established to figure out what an expectation gap actually means. Between what one is expected to do and the gap between what one actually does. Okay, this was identified as the first gap. Then followed up 20 years later, in 93, there was a Porter Commission that was put in place, again evaluating what is expectation gap, which means even after a study was done in the 1970s or late 1970s, the extent of change or improvement both in the mindset of the stakeholders or that of the auditors, or the extent of change in the way an audit is carried out had not tremendously changed enough to bridge the gap. The gap still existed. Probably because as auditors improved, the expectation gap also went up. So the extent of gap more or less remained consistent. So a far more detailed study was done to figure out what this expectation gap actually is. So if I look at it, there are various factors that come into play. One is the ability for auditors to detect fraud. What their responsibility is. Is the auditor responsible only to the shareholders and members, or do their responsibilities expand to other stakeholders? Because these financial statements, for example, are relied upon by tax authorities, by bankers. So does your responsibility therefore extend also to them? Or do you say anyway, for example, if it's a large private company, the shareholders, board of directors are the same. So you discuss with the board. So your responsibility over, so shareholders are fully aware, you don't need to inform anybody else. And therefore take safeguard that my audit report is clean because these matters are discussed with the board. Can that be a reason? So there was clearly a gap between what the expectation of the stake, and when I say the stakeholders, I'm not referring to shareholders. The people who have a stake, because as I said, tax authorities, bankers, all of them rely on these financial statements. There could be analysts also who might be relying on it. So a lot of this information for them is also critical, and therefore the fact that you're reporting only to members would not necessarily serve as a safeguard. Capability for assessing the nature of balance sheet valuations. Now with the new standards coming in, whether it's under Ind AS or IFRS that we're looking at, a lot of things require to assess based on fair value. There was a time, especially around 2007-8, before the RBI intervened, there were very unique derivative contracts that banks were giving companies. The rupee would be linked to Swiss franc would be linked to US dollar would be linked to something else. And till 2006-7, when these derivatives were given was fine. 2008, for everything said and done, there was a sudden shift in the exchange rates between US dollar and Swiss francs. Suddenly all the derivatives became loss derivatives for companies with a loss varying from about 30-40 crores, 30 crores to about 1,100 or 2,000 crores impact, depending on the value of the derivatives that they had taken up. And a lot of these companies, at least in Thrissur and area, filed complaints against banks and actually took it to courts, and the banks did not tell them of the issues that were involved. After which the RBI actually came out with a notification restricting banks from giving such unique forwards or derivatives. So till then, from an auditor's perspective, were we able to value such derivatives? The question was, it was very difficult to value because the cross-linkings were such. You will now have complex derivatives that come in. If the forward works as an option, if the exchange rate is below 75 rupees to the dollar, then you will transact at this price. If it is between 75 and 82 rupees to the dollar, then you will be transacting at this price. If it exceeds 82, then you will transact at this price. There are three scenarios within the forward, and serves as an option. Now, how do you value it? Because this option is effective 6 months down the line, 1 year down the line. So you have to value it as of today. So these are very complex derivatives that are coming in. And as I mentioned earlier, just because you have a CA degree does not make you competent to sign a balance sheet. You have to have the other capabilities. And this may require complex valuation models. So did the auditor, when looking at these, evaluate the need for involving an expert? Did they have a reasonably good expert, whether internal or external? Evaluation of threats or auditor independence. This was another matter that kept up. Of course, there were a lot of regulatories. The Code of Ethics kept getting amended. Most recent amendment now was in 2019 that happened. But the revisions were also to evaluate and put restrictions on what an auditor can do and what they should not do. Again, these revisions came up if you go back to the Enron scandal. The biggest statement that was made of Anderson's was that they not only were the auditors looking at these transactions, it was actually the consulting wing that gave advice to the company on how to do these transactions. And therefore, the auditor's independence was not met. Because how can the auditor question their own consulting? And therefore, they should not have. Whereas their argument was the consultation was done for the subsidiary and not for the parent, and therefore independence was being met. So a lot of arguments. But there was serious concerns on auditors' independence. Even if some of the NFRA reports that you look at, there are concerns that have been raised significantly on auditors' independence as well. Another one is the aspect of conducting audit, ability to cope with risks that come in. Key aspect again is, I said there is an auditing standard which requires an auditor to consider the risk of fraud. A lot of cases, if you start looking at files, and that's one of the aspects that I've also done across various firms, we looked at engagement files. Discussion with the NFRA committee and the chair also indicated that the biggest concern was auditing standards recommends or advises two frauders. One is on revenue recognition, one is on management override of control. If you look at most of the audit files, either A, the firm has missed mentioning these two itself, which is mandatory under the standard, or these are the only two fraud risk factors mentioned in the audit file, indicating that did the auditor even apply their mind to see whether there are any other factors that need to be considered. There was nothing in the file to demonstrate such thought process. So that was where the concern was coming from. So is the auditor actually able to identify relevant risks? Do they have the capacity and capability to address those risks? So these were the 5 factors which actually impacted what the expectation gap was created. So what did all the studies do? So some of these are extracts from the Foreign Accounting Standards Board, or some from the US when they carried out certain reviews on expectation gap. So you have 3 which they started putting. One is knowledge gap. What is the knowledge gap? This is what the stakeholders expect you to do, which is always higher than what can be done. The public comes back and says, auditor was responsible to find the fraud. Auditor is arguing, saying, I'm not responsible to find. I'm supposed to evaluate the possibility. If I do find, I will report. But not that I will go sniffing, because I'm not a forensic auditor. So that's a gap between what the public wants and what an auditor is able to do. Then you have the performance gap. What is performance gap? The gap what the auditor is actually able to do and what he actually does. Auditing standard says these are the 10 things you need to do. But out of the 10, you applied your judgment in only 5 of it. Why? No answer. You didn't think the other 5 were relevant, you didn't have time to do the other 5, whatever the reasons may be. The evaluation as to why you did not do all 10 procedures is not appropriately documented. And when the standard says you have to do 10, expectation from people outside is you have done all the 10 activities. Because your audit reports did not identify that out of the 10 you chose to do 5 and did not do the other 5 because of these reasons, is not available to the outside stakeholders, resulting in a performance gap. Which is also, if you look at a lot of the QRB or the NFRA reports, the items that they have identified is significantly falling in performance gap. So this is required under the Act, this is required under the standard, not done by the audit firm. The other third gap that comes in is evolution gap. What is this? Technology is constantly changing. The time when we did audits, if I go back to my articleship days, accounts books were all manual books. Our audit files are also manual. So now, where everything is electronic, you may use something as simple as Tally or as complex as Oracle or SAP. But still, everything is electronic. Data is available at the press of a button. Your work papers are being done on laptops. The amount of writing down has been reduced. Or desktops, not necessarily laptop. But it's all become digital age. Which means, now if somebody wants to misrepresent information, the amount of data that we are handling is significant. A single if I look at a complex ERP like SAP or Oracle, a single transaction, which otherwise I would have recorded as one journal entry, will probably end up getting posted as 3 or 4 journal entries within the system. So, because there will be one adjustment entry which goes, updates into one back-end system, the back-end system posts another entry, so they are all consequential entries that before getting impacted in the books of account, there will be 3 or 4 transactions coming. So, if I want to play around with the numbers, I can tweak it somewhere at the back-end, a lot of things could change in the front-end. Nobody knows what's happening. Depreciation. We are confirming that the SAP system is what is running depreciation. I press a button, depreciation run happens, everything is automated. Company can go at the back end, change the useful life as they want, do a depreciation run, set the useful life back to what you want to see. But nobody knows. Do we actually sit and recompute the full depreciation? May not. A lot of people rely on the system. So I looked at the useful life that's there in the system, I looked at the formula the system uses, both are fine, the depreciation must be fine. Which means competencies on this evaluation. Do we have information technology experts within the audit team? Of course, the institute did start with the DSA certification, but do the people involved on the audit have that certification? Are specially certified personnel involved, whether it's internal, external, as part of the engagement team to provide comfort? That's an evolution gap. Now we are going into cyber currency. Now, cryptocurrencies, when they came in, that's the only time I've seen the fraternity come together and say, we will not audit any companies involved in cryptocurrency because we do not know how to audit it. That's the first time they've come together. Because that was the first time in India, no CA firm was ready to sign up on a company involved with cryptocurrency. Because there is no specified auditing standard as to how to go about testing this, and nobody knew what to test. So understandable. But did we ever take this position for anything else? No. Everything else as a fraternity we said, yeah, we can do. Without really giving thought whether we have what it takes to audit it. As there is a change that is happening between what we learned when we were articles to what is now happening in the industry. So that's the third gap that's coming. So what are we doing to fix it? Knowledge gap, of course. Lot more information is being made public. The inclusion of key audit matters was one key reason that came in to bridge the knowledge gap. So that the stakeholder knows what risks did you actually identify as critical and what procedures did you actually do. Of course, this attempt to fill the gap resulted in other gaps coming in. One, other than the institute publicizing or publication coming out on key audit matters summary for guidance. People have not used it for guidance, have used it as a library, copy pasted the CAM and the procedures from somebody else's audit report into their audit report. In fact, when you look at their files, the procedures they've explained, they have not done. Because somebody else had done those procedures, not this auditor. But because the wording's English was good, they just ended up copying it. Now we actually had a case where the NFRA asked that question to the auditors, saying, this is what you put in your audit report as key audit matter, these are your procedures. I have gone through your file, I am unable to find any work paper in line with these procedures, please explain. Now we are trying to help that firm on how to respond to that question. But it was a very valid question because clearly both the CAM and the procedures were probably taken from the institute's publication as it is without evaluating how much of it actually applies to the company under audit or what revised procedures was the firm actually doing. So So again, that can't be the case. So even though an attempt was done to bridge the gap again is failing, not because of absence of information, because of the performance gap that is coming. So unless they start bridging all of them, it still becomes a problem. Now, as an institute or as a Ministry of Corporate Affairs, efforts have been made by both to bridge both these gaps by bringing out guidances. The summary of CANs was given as a guide, not for audit firms to copy, but to take reference as to what are the possible CANs that can exist, so that when they audit their clients, they can evaluate whether this exists as a situation, and if so, whether this actually is a CAN or not to copy paste something that exists from there. There were practical guides and implementation guides that were given. The ministry has come out with various notifications of what needs to be done as amendments. So if you start looking at all of them, they have tried to bridge both. NFRA's role significantly is to bridge performance gap. And therefore they look at the auditing standards not as guides to auditors, as to way we've been looking at it all these years. For them it is law. The Companies Act requires the auditor to comply with the Code of Ethics and the relevant standards. The Code of Ethics mandates you comply with all auditing standards and guidance notes. So for them, this is not an option to you. This is not an element of professional judgment to you. It's not an element of, I will take it as a guidance and see what I need to apply. It is a law, either you apply or you don't, because it's referred to in an act. And all the rules that become part of the act are all law that is there. So you can't have a case that I partially jumped a signal. Either you jumped the signal or you didn't jump the signal. There's no partially jump. So that is the same way the NFRA is looking at all the auditing standards. Either you complied or you did not comply. There's no in-between grey area saying I partially complied. And that is where the issues, if you start looking at all the reports, you find that is the key place where all the issues are coming up. So regulatory guidances, all of that is there to build the knowledge and performance gap. So let's come into what audit quality is, what the AQMM model is, why I think it's critical, especially for a firm that is in audit practice. If you look at what the AQMM is, this institute did come out and say this is a capacity and capability building model. And it's a self-evaluation model. So it's like a checklist where you answer it, and if you look at most of the points that are there, they're very simple questions. The answer is either yes or no. Same time, there's the same way how the NFRA is looking at it. It's like a law. Either yes or no, there's no gray area. And therefore here also when you start looking at it, you can't say, I am applying this in principle. That's a gray area. Either you have a clear-cut written policy and you're able to demonstrate that this policy is actually performed. I'm sure all of you have audited internal financial controls while reporting for companies. So there again is the same practice. A company can't say I have this control process and there's nothing for you to test, in which case you can't open. And a company says this is my control. We should be also able to demonstrate a documentation to say how that control is actually put in practice. And as an auditor, you will validate both the control description or policy the company has and the documentation supporting how the policy was actually implemented to confirm on internal controls whether they were appropriate or not. That's the same thing that holds good for the AQMM. Therefore, firms cannot just make a statement. They need to be able to validate that with supporting documents that this is actually implemented. Key pointers, yes, it's self-review, but it's also subject to audit. Because the peer reviewer once in 3 years will come and validate your compliance with the model. There are 4 levels of scoring. The P1 is very nascent stage, below 25% compliance with the quality maturity requirements, to L4, where somebody has achieved more than 75%. So these are the levels. A key thing that I'd like to highlight here when you start looking at these aspects is there's a lot of talk that's been going around. Yes, there's a white paper that came out. There were objections raised by the larger firms on joint audits coming. Key reason, why are larger firms objecting to joint audits? Simple reason, no company is going to keep 2 large firms as its auditors. Managing 2 auditors itself is going to be a pain for the CFO. So there will always be with one large auditor, a slightly larger firm or a mid-sized firm, not one of the large firms. So it will never be one big 6 with another big 6, no. It will be one big 6 with a mid-sized firm. That will always be there. So as to be able to manage it better. That's also one of the reasons why this is looked at as a capacity building model. Because the only way you start being able to be competent is if you build capacity. And the reason the large firms are objecting to this is because, in their opinion, there are no firms that have taken quality to an initiative to build themselves up in capacity to meet what they perceive as audit quality. See, the big six themselves may not necessarily be at the top of audit quality, but they have a journey, they have put in the effort. So their concerns are other firms doing the same. And if not, it's very risky to work with them. Because you cannot split a set of financial statements in half, saying, I will do half, you do half, both of us will sign off on audit report. Very difficult to work that way. Unless you're able to demonstrate that yes, your quality is up to standard. So this AQMM helps you evaluate that. So if that does happen, there's a high probability that when the audit committees and as the roles and responsibilities of independent directors go up, that when they do a selection of an audit firm, they will prefer, if not an L4 firm, minimum would be an L3 firm. Below that, they would not even want to consider the firm. Because the amount of audit quality you are trying to achieve should be at least at a minimum of above 50%. You cannot be below 50 and claim yourself to be a quality oriented firm. Right now, who is this applicable to? All firms which audit listed entities, banks and insurance companies. Right now, it's exempted from those companies who are doing branches of any of these entities and therefore not signing off on the main. I don't expect this exemption to stand for long, because there's also talks right now as to whether AQMM should get extended to all those firms who are also auditing large unlisted entities. So the institute is considering it. Only thing is, large unlisted is not defined currently, but if large unlisted can fall into place, I don't see any reason why branches of large listed entities can't fall into it. So this may get delayed a little bit, may come out by April 25 or so, but I do expect that branches getting covered under AQMM will arise, which means all firms saying I only do some branch audits and nothing more may also need to start evaluating then, do I need to start complying with some of this. Again, L3, L4 may not apply to branch auditors. The minimum the company may look at is an L2. So you can't be an L1 firm and say I still want to do branch audits. So there will be a mechanism that will come. Now how do you move up? It's by building capacity. So that also is something we'll try and discuss. So L1 is those who meet less than 25 weeks, and mind you, it's in each section. Therefore, if you have two sections which are at 45, one section at 15, you fall in L1. So even though there are two which are about 25, below 50, don't go into L2. All three have to surpass 25% for you to move to L2. Similarly, L2 is where it's 25 to 50, L3 is 50 to 70, above 75 is L4. Now, how are these split up? There are key sections. That is on practice management, basically looking at operations, which has about 280. That's the maximum score that's available. Then you have all your HR related items. And surprisingly, there's a huge amount of scoring put to them as well, about 240 points going into it. And then you have the strategy and functional aspects of practice management, which has about 80. Total score, therefore, available is 600. And that's how you need to score to between L1 to L4. What is the minimum score you can get and what's the maximum. And you have to get these scores for all the three categories in order to fall into the respective scoring. So let's look at what practice management operations mean. There are about 280 points. Now these 280 points are also further split up into various categories. Okay, so if you look at the brain, there are about 9 sections. You've got your practice areas, which signifies what all services do you provide, how much is audit, how much is non-audit and things like that. Your workflow on practice manuals being available, do you have an audit approach manual or not. Your quality review, principally compliance with SQC. Your service delivery and effort monitoring, availability of timesheets, quality control on engagements, which is your EQCR, benchmarking of service delivery, basically trying to see how are you comparable to how others are providing service. Client sensitization, that is your involvement with the client in discussions that you have it. Technology adoption, are you still working manual work papers, electronic work filings that you've done. Revenue, budgeting and pricing, how your overall operations is done. Especially on the fact that whether you are undercutting on your fees, are you quoting the correct fees, do you have something to monitor that a lower fee or an engagement has not impacted overall audit quality. So these are some of the factors that come in. So each of these sections again has scoring. So maximum score is what I put under each of the sections. So in order to get the maximum score that you want, let's say you want to fall into an L4 category and you have to get 200 points, 211 points to be able to be in an L4, or more than 141 points to be in an L3. You have to look at, how do you capture on all these scores? Looking at that, you have to accumulate. You can't get more in one. I can't say my quality that I'm managing is very high, but all you can get on the quality is 24 and 80 in case of EQCM. You can't get higher than that. So you have to start looking at what can I capture. And surprising part, as we go through this, you'll also see a lot of these factors are interrelated to each other. Okay, they're not independent of one another. So each one has an interlinking. So if you say yes in one, it has to be yes in the other. But if the other, based on the questions, is a no, you'll have to go back to one and say no, in which case you lose points. So what are these that I'm looking at? When I'm looking at the overall practice area, the key factor of AQMM is it applies to a firm which is significantly specialization in the work of audit. Whether this audit is financial statement audit, tax audits, internal audit, GST audit, forensic audit, as far as it's a test-related function, it falls under audit. So initially when you look at practice area, the audit revenues for a continuous period of 3 years has to be a minimum of 50% of total firm's revenues, in which case you get 5 points. If it is above 75%, then you get 8 points. The vision and mission statement, this means all firms should have a separate vision and a separate mission statement. And this should be forward-looking. It can't be a past glory-based vision and mission statement. It has to be forward-looking. And there should be anything evidencing implementation of the vision and mission, which means just putting it up there as a statement will not work. You should be able to demonstrate what activities as a firm have you started putting in place to achieve the vision and mission statement that you have. Only if you are able to demonstrate it, you can get 4 points. So, when I first made this presentation last year, one of the questions that came up is, there's a common practice between CA firms. I have an audit firm separate, all my other functions is a different firm. My tax is in another firm, my valuations is another firm. So if I do it that way, then by default my audit firm is 100% audit revenues. Now there are 2-3 factors I want to look at. Saying A, if you are a firm which is associated with an MNC in some way, chances are even though they are separate firms, all of them will form part of the network. And therefore you may have to look at the definition that is there within the Companies Act, saying firms which are working under the same brand name, even though they may not be linked as a network with the institute, may still fall under network as or related parties for this purposes. So when you fall under that, even though you're not registered as a network with the institute, you will be looked at as a single firm and evaluated whether your audit revenues meet the mark or not. I'm in concept, I don't know exactly how the implementation finally will happen, because till the first AQMM review happens, we don't know how this will be looked at. Documentation on the vision and mission should be available, defining both what your medium and long-term vision and mission is. So the mission statements that you have will be on how you intend to achieve the vision, and the vision itself should be forward-looking as to where it is you want to be in, let's say, 3 years from now, 4 years from now, 10 years from now. And the key aspect there also, this vision and mission should be rooted on what core ethics of the firm is going to be. Next one is on workflows, practice manuals being available. What does this mean? This means as a firm, you should have sufficient documentation in the form of audit manuals, ensuring consistency with how an audit is carried out by every member in the firm. When I say every member, if it's multi-office located firm, then you are ensuring that all the offices are doing the audit in the same manner. It's not individual as to how this person does on documents and how another partner does on documents. No. All of them should be consistently done. To ensure this, there should be a clear-cut audit manual. And this audit manual, whatever is prepared by the firm, should ensure compliance with all the applicable auditing standards. There should be standard formats that are given. The standard formats should be format management representation letters, engagement letters, how significant work papers should look at, formats for confirmation we send out, a standard format of how an audit report should be drafted. Okay, these standard formats should be A, existing in the firm, 2, be made available to all staff in the firm. Now, if you have these two, then yes, both of them, either it's a yes or a no case. And again, as I mentioned, it's both existence and implementation that gets validated. Meaning just having standard formats is not enough. These formats should have been made available to all staff. So either you get a 0 or you get 16 based on how these two go. Then you have your quality modules. This is actually having as many yes and no answers again. So you have a few questions. And if you look at it, these questions are aligned with either the SQC or the code that exists. Client and engagement acceptance checklist. So here again, just having a checklist will not do. The checklist should be existing, and this is what the firm should be using when they accept a client or an engagement. So there should be clear evaluation of these checklists that happens. Then you have an evaluation of independence. Whether this is done only for the audit partner or this is extended to the full engagement team. It should be for both. So you should have how the evaluation is done, and you should be able to demonstrate that for each engagement, independence evaluation is carried out before the engagement commences. Policies for engagement withdrawals or rejections. So you can't just have a format or process for acceptance of a client or acceptance of an engagement. You should also have a process on how these clients or engagement could get rejected, where a firm goes back and says, no, I do not want to do this. Now when you get into this, actually, I'm sure you saw in the newspaper, I think November of last year, NFRA did pick up the 5 large firms in India and said we will be reviewing them. So there they were not picking up individual files for review, they were reviewing the SQC of those firms. And one of the points that came up when the NFRA team was sitting was, you guys have wonderful client engagement acceptance. Say what process needs to be followed, how many partners need to be available, what documentation needs to be done. But can you show me your policy, or not only policy, implementation of withdrawal? How many cases did you fill up this checklist, and based on the checklist said, no, I will not do this audit, or no, I will not accept this client. Can you show me examples where you rejected having filled up the checklist? Fortunately, of course, the firms had it, but the key learning that came out of that is, you cannot decide to work with a client and then fill up the checklist. You should first fill up the checklist, get all the information that is required, and that information should supplement whether you want to continue this engagement or not. So that is what they're expecting to see here. Now, standard checklists for compliance with accounting and auditing standards, which means the firm should have checklists for compliance with all accounting and auditing standards. Of course, to benefit this, Institute has already released a lot of these checklists. So you can just take those checklists and start implementing it. Formats for business understanding, materiality and sampling, data analysis and controls. So in the previous question of 1.2, we spoke about standard templates being made available. Now the 1.2 is linked to 1.3 when it comes and says there should be formats for business understanding. So there they left it open, saying standard formats for key areas. They specified here that some of the key areas include business understanding, materiality determination, sampling, data analysis, controls testing. So these again should be made available and implemented in all audit engagements. Above these SQC documents, how are they often reviewed and updated? Now this was an interesting part. Now, in my profile I had said, one of the services we provide is providing quality as a service to audit firms. So in this process, when we started interacting with a lot of firms, a key feedback that we got from most of the firms is, the last time they looked at their SQC was when they first applied for peer review. Because one of the key aspects to apply for peer review certificate was existence of an SQC. So that's when they prepared the SQC manual. So when we discussed and how did you go about it, nothing. They took the standards on audit quality that exists within the auditing standards. So what are all the sections, copy pasted it into Word, just added on how they plan to do, and that was it. So it was done some 6 years back, 8 years back, 10 years back was the last that updated the SQC. Because the auditing standard also didn't change, the SQC didn't undergo a change. They have also not touched the SQC. Okay, so that is not right. As your plans change and the operation change, you need to revisit the SQC amendment. That being said, of course, there's also a proposed AQMM that is coming out now, in line with the ISQM 1 and 2 globally that is existing. It is still in white, and we expect it to be notified by the Institute by next year. If that comes in, that replaces the current existing SQC standard. It becomes more wholesome, and that standard actually requires you to visit it annually at the minimum and make changes to it. And that is, from an auditor's perspective, worse than an IFC case, because that ISQM or SQM requires you to have a risk response matrix for all the 9 or 10 elements that are there within the quality manual, which is similar to your risk control matrix that your client should have had from an IFC perspective. Auditor keeps a risk response matrix. So those are the new things coming in. So factors to consider when you're looking at this, it's just not practice, but maintaining detailed policies, procedures, including how these have been implemented. And as I mentioned earlier, this has to be read with 1.2 on standard formats. So you can't say yes there that you have standard formats and have a no here with regard to having standard formats of business understanding. So if you say no here for this format, you'll have to go back and say no there also. Because as I said, there's no gray area saying I have some standard formats, some not there is not a case. Either you have it or you don't. Effort monitoring, again, whether you're maintaining timesheets is one, but other than that, capacity planning for each engagement. Which means if this audit engagement requires a staff of 3, have you sent 3 people on the engagement? How have you confirmed that the staff required on the engagement was only 3 and not 4? So that documentation should be there. And if the requirement was 4, what steps has the firm taken to have sufficient staff? Be it through recruitment or reallocation. So the firm has to have processes on how they do this. Which means beginning of the year, the firm should have looked at all the clients that they have, time frame when these audits will be done on these clients, staff required on these clients and which points of time will the staff be required, and confirm that any point of time the firm has sufficient staff to be able to address all of this. If not, start with the recruitment upfront. So basically that is what this is supposed to be addressed. So it's not at each engagement beginning that you do the planning. This is more at the firm level, whether you've done overall capacity planning. Again, if you are able to demonstrate that yes, you've done all that, look at the effort that has to go in. This has to be annual planning that you look at. So you should have done all this planning to get 4 points. Maintenance and process of budgeting and planning of efforts. So again, there should be a mechanism by way how you are budgeting the time required for these audits. It's not, this audit I'll take 200 hours. No, there should be a process. How did you budget this engagement takes 200 hours when you did your capacity planning, which is the first one. So you should have a detailed process, how long a specific audit, size and structure of the audit should take place. And of course, once you've done the budgeting in that for your capacity planning, actual monitoring also should happen in the same system. So there's a comparison automatically that happens of actuals with budgets. Of course, actuals and budgets is in another section. This talks about the ability to capture for actuals and budgets. Analysis of actual and budget, which is now the next point coming out of it. And you look at how this affects your costing and fees. So it's not just getting the details of actuals and budgets, you have to compare it because your budget is the basis of your fee negotiation, and therefore if your actuals exceed budget, you have to evaluate, do I go back and ask for fee increase? And if you have not asked for fee increase, could impact your evaluation here. Because the factors being considered is when your fee is lower than what your cost is. First thing to get cut is audit quality. After cutting off on audit quality, next thing to get cut is staff payments. Increments will not be there. The last thing to get cut is partner salary. So that is the last one to get cut. Otherwise, first one to go is audit quality. And therefore, that's the key factor they bring in here. Saying if the actuals exceed budgets, then have you gone back and evaluated, do I need to increase the fee? Because they don't want audit quality to be cut. And by practice, that's the first thing that gets cut. So here, number of engagements that have been for this information and complied and verified. If it's up to 10%, then you don't get any points. So they've gone up. So only if it's above 90% of your files, this evaluation is done, then you get up to 20 points, which is a maximum under this. So you can go to 0 up to 20 depending on how many engagement files of the total number of engagements as a firm that you have. That is analysis of actuals versus budget is being carried out. Deployment of technology for monitoring effort and project management tools. So again, it could also say I'm using Excel for all of this and claim that Excel is also a technology. But other than that, having cloud-based timesheet capturing mechanisms, whether that's being used to monitor how many hours a day somebody is putting in. If somebody opens their laptop at 8 in the morning, logs off at 12 in the night, does that actually mean they work 12 hours or did they just leave the laptop open? All those mechanisms should also be there to evaluate whether any work was being done on the laptop or just left open. So how to technology used to monitor the effort and project management? Key thing that comes in here is it means in a lot of cases audit firms will start to have MIS systems in place. You've seen your clients have budgetary MISs that goes in, reports of actuals to budget comparison that get filed. But in a firm that may not necessarily be happening. But if you have to start doing all of this, the firm may also need to have monthly MIS at the minimum, where it looks at total time booked by all staff, against what was budgeted for that month. Are we within budget? Are we surpassed budget? Are we having staff working overtime, late, consistently? Do we need to increase the number of staff? This evaluation has to happen at a monthly basis. Quality control for engagement. This is more on EQCR. The maximum score here is 80. This of course has to be in compliance with para 60 of SQC 1, and if the new SQM comes up, it will be in compliance with SQM 2. Whether you have a policy structure in place as to which engagements get subject to EQCR. So if you have it, then 8 points. If you don't have it, 0. Now it's not, as I said earlier, not just the policy, implementation of policy should also be happening. And if you look at some of the NFRA's comments, their concerns have been that though there's an EQCR partner, evidence and documentation supporting EQCR was actually carried out was not sufficient, and they have also penalized therefore the EQCR. So the engagement partner might have been debarred for a few years, EQCR partner also has been debarred. So this is also getting a lot of focus. So just having a policy is not sufficient. You should be able to demonstrate it. Also a tracking of engagements which have been concluded as satisfactory as per quality review. How much is internal? The number of engagements by total engagements you can do, you can get up to 0 to 20 points. How much are done by ICI when they do the QRB or peer review? How many engagements with nil findings compared to how many engagements were selected for review? So based on from a grading of less than 10% to about 90%, you can get from 0 to 20 points. So roughly between these two itself, you get about 40 points. Whether you have the documentation as per SQC 1 covering acceptance, ethics and performance. Leadership roles on quality, HR and monitoring. Now when I'm looking at leadership role on quality and human resource, keep in mind this will also be looked at from the second section of AQMM, which is the HR component. So if you meet this as yes, all of the other side also should be substantially working, because there if you come up saying don't have sufficient policies over HR, you have to come back here and say no. So these are all kind of interlinked. So it's not I finish one section, I will look at the next. So you have to look at all the interdependencies that come in. Accounts and audit resources being available, whether there are Q&As, ready reference guides, technical libraries, thought leaderships from the firm, which is made available by the firm to all its staff. That's going to be a key aspect which will be looked at here. Time sheets that is spent, and on the time sheet, principally here is just not hours in a day. They have asked for a comparison of time spent on business understanding and planning, which means your timesheet would capture minimum 4 aspects, which is planning and risk assessment, audit execution or field work, audit conclusion or reporting, and assembly and archive. Therefore, your timesheet should be at minimum be split into 4. You may further split it to additionally capture other information, but minimum these 4 categories have to be there. And of that, the first category on which entity is environment, understanding of business, understanding of controls, the risk assessment, mitigation plan, which is all part of planning section. You have to evaluate and see whether the time spent is appropriate. So whether you're doing all this, again, gives you 12 points. If you're not doing this, it gives you 0 points. Continuing, some of the things that we need to factor here is when you're doing all this planning, capacity, ensuring you have sufficient resources, the planning is done upfront, you're capturing the time, and again, as I mentioned, having an MIS system where you start monitoring whether things are going as per plan. This monitoring should happen not just at the firm level, it should happen at the engagement level, which means the engagement partner should actually monitor saying has sufficient time as planned and budgeted been spent on planning. Because this is where even the concerns from NFRA is coming in. The reasons why fraud considerations are not factored in an audit is because audit teams from day one start with execution. There is no evidence of planning. And by practice, when you start looking at a lot of firms, and having worked in one of the big 4, when you speak to the big 4 firms as well, key factor, the expectation is about 60 to 65% of your overall audit time should be spent only on planning. And therefore 15-20% will go in audit execution, about 10 to 15% will go on audit conclusions, another 3 to 5% will go in assembly and archive. So that is how time has to get spent. So, but when I spoke to a lot of other firms, it was total opposite. About 3 to 5% was spent on planning, About 55-60% or 70% was spent on execution. 5% or so was spent on reporting, because nobody spent time on reporting at all. Another 10-15% was spent on assembly and archival, because when you discuss with them, a lot of companies came back and said, I might have signed my audit report today, but a lot of the data for notes, everything came in tomorrow. Because board meeting had to happen, I signed the report today, but effort continued. So a lot of that time also goes into assembly archive, which is wrong. And your timesheet should now start capturing. Now the whole problem comes in the need for a timesheet is captured in various sections. And if you don't have a process of capturing, you get zero in all those sections. So you have to set up a system. And once a system is set up, monitoring has to happen. Benchmarking of service. This is again looking at how your peer review comments might have come in, where do you stand based on the QRB, FRRB comments, all of that needs to be factored in. But principally looking at, do you have a standard delivery methodology, which as part of your standard process audit methodology you put forth, and having put it, is that consistently complied with all partners and staff? If yes, 4, if no, 0. Now this is an area where there are certain negative markings. Now it is here and another section where negative markings are available. Now that is if any of your files have a negative comment, and this negative comment could be files audited not just by ICAI or NFRA as such, but also could be from the CAG. If you are doing empaneled work and CNDG look at files and negative comments on how that file was actually done or audit was done, and they are not happy with the work of that auditor, that also could serve as a negative comment, resulting in whether you have to rework on either the documentation or if you have to rework on your opinion. So number of audit engagements reworked, number of clients dispute. This is disputes other than fee. If the dispute is arising out of inadequate audit done, especially because let's say there have been cases, 2 shareholders start fighting. There are 2 investors, they start fighting. And there is questions as to how the auditor signed off on the report when these errors exist. So if that comes up, and this is not discussion on fee, this discussion that the shareholder, one shareholder is claiming the auditor sided with the other shareholder, and that's the basis on which they signed off the financials. Now, do you have documentation to argue with that? How many such cases resulted in you having to fight? All of that gets looked at when you're trying to see whether there are sufficient questions coming out questioning audit quality, and that is what gives you negative markings. Another one that gives you some positive marks again is timing of audit interactions with management. Now, there have been a lot of focus, and there was a recent article also that came in where the NFRA chair has said there has to be increase in communication between auditors and management. Now that's also sitting in the AQMM. Not only should there be an increase in the communication, but timing of these communications. Now if you look back at your audit report under SA 700 that you're issuing, under responsibilities of auditor, towards the end after giving the whole bullet points of responsibilities, there is a paragraph which says that as an auditor you have interacted and communicated with those charged with governance, your process of risk assessment on the engagement. Now how many of you as part of audit have actually shared a presentation with those charged with governance saying these are the audit risks that are identified, these are the risks which are significant, these are the risks which are not significant, this is how I'm planning to audit. 90% of the cases, it's not there. All you have at most is perhaps a letter or a small presentation made saying everything is fine. I have looked at the audit, no observations made, I am making a statement, I am independent on this audit. That is what comes in the board presentation or audit committee presentation. The other aspects, though you are stating it in the audit report, is not coming. Now that is part of planning. So indirectly what I am saying here is when it comes to interacting with management, there should be multiple points of time that you are actually interacting, and it's not limited only to year. Client sensitization, which means again as far as the audit procedures are concerned, the audit plan is concerned, how often do you meet up with the client and discuss and plan. So your planning meeting or discussion not only with the board, but it can also be with the client. For example, you want to circulate confirmations. You decide you want to circulate confirmation from an interim balance. Now have you discussed with the client, because they need to close their books of account as of that interim date for you to facilitate a confirmation request. If they have not closed the books on interim date, because by practice and plan, they close it only at year end. Then you sending out an interim balance will never agree with the other company, because the company themselves have not closed their books. So you may want to discuss this upfront that you want to do this to facilitate them actually doing that book closure at that interim date. So you have the balances for confirmation requests. So these discussions of your plan needs to happen with the client. So how often do you have these meetings? Which again indicates that if you go meet a client only at year end, you will probably get 0 points for this. So you have to have met your client other than at the year end audit. We spoke earlier about timesheet maintaining. Again here, your monitoring of planned, budgeted, actual hours. There we were looking at it from internal MIS. Do you monitor it, track it, evaluate it? Here it is looking at, have you discussed this with the client? So have you spoken to the client saying, when I quoted my fee, I budgeted 1000 hours. But right now I've spent 1200 hours. Is the client aware? Because chances are the additional 200 came because of two reasons. Either the auditor's incompetency, they had planned to put 4 staff, they didn't have the 4 staff, they recruited brand new people didn't know what they were doing, and therefore 200 got spent. That is the auditor's incompetency. Or it could be the client incompetency. They had promised to give you a set of financials on a certain date, they gave you 1 week late. The information schedules they gave you, none of them are matching with the accounts, they had to redo and give it to you. And therefore you end up spending 200 hours extra. So has this discussion happened with the client, especially on their incompetencies? And therefore, either you ask for a fee increase, or you worked out a plan to make sure that these incompetencies or errors do not occur going forward, so that going forward at least your budget and actuals can be met. So that's again client sensitization. So either you are doing this or you are not doing this as a practice. Again, this is all black and white. There is no gray area here. So either you are doing it with all your clients or you are not doing it with all your clients. You can't say I do it with, top of my 4 largest clients I do it, the rest of them I don't do it. It may not work. Of course, again, there's an element of judgment that the peer reviewer will probably apply. Saying, okay, if you're doing it for all listed clients, I may give it to you, but logically when I look at the AQMM, it's a clear-cut black and white only. Technology adoption. Now there's a huge list that is there, and whether you adopted technology. So it says yes or no, and whether it's been implemented for all staff. Each point when you say yes, you get 4 points. Wherever it is no, it is 0 points. Do you have an internal chat communication? Again, when it gives this, keep in mind all security features should exist, which means whatever chat you are having internally cannot be accessed by somebody outside of your system. So whether you're using Yammer, which is a corporate account, or using, say, any other form of chat like Microsoft Teams using a corporate account, or Skype using a corporate account. So whether it is whether its corporate account is being maintained, whether it's being used. If you do not have a form of internal chat communication, 0 points. Automated attendance leave system. Now only thing here when you look at automated, especially in the field of audit, unlike companies, I cannot have access card related, biometric fingerprint related attendance. Why? Because 80-90% of the time I report to my client location, not to the office. And therefore, how do I still monitor an attendance system? Which could mean when I open my system or laptop, I have a login mechanism. System automatically registers the login on the laptop. And therefore, I know that work has commenced. So that captures that yes, I did not keep my laptop closed for an extended period of time. Could also take the risk that means your staff should have a constant access to internet. Project and timesheet management. Again, technology has been used for both. And I think in the earlier section also we spoke in 1.3 that you have a method of managing project management. So now they've gone and said that should be technology based. Digital storage of records, which means either cloud based or server based, where again in 1.2 when we spoke of standard templates and formats, there were guidances that were required and made available to all. So you should have a centralized server or digital storage where all of this is maintained. There should be a digital library. This can be the firm's own digital library, or you can provide in your intranet a link to the institute's library. Client interactions. There should be alerts, updates that you are being sharing. A lot of firms do have this practice that they share updates or alerts. There's a change that happened in GST, an alert goes out. They put it up on LinkedIn or they put it up to all their clients. So that process should also be there. Video conferencing facilities should be available at the firm. Use of licensed operating systems and software. Again, this, when we were speaking to some firms, they were concerned. Though the firms clarified that no, all the Windows software on their laptops are None of them are pirated, are licensed. But a lot of firms say they have something called BOYD, that is bring your own device, where they recruit the person brings their own laptop. So there, however, we do not know whether it's licensed or not. So again here, whether you have a BOYD principle or no, a firm which is using any software that has to be licensed. So if you've got the person coming in, make sure that person got a licensed software on the laptop before you facilitate that laptop connecting into your cloud. Own an email domain usage policies. Basically, you should have an office linked email. Nobody should be using their Gmail accounts for this. Those are personal accounts. So there should be a corporate account, and there should be a policy on how this corporate email can be used. Basically, corporate emails, do not use it for personal purposes, and therefore you will classify what is considered personal purpose. Antivirus, malware protection tools should be available. Data security aspects should be addressed. Cyber security should be addressed. Because as auditors, the amount of client information available with you is high, and client information is confidential. And therefore you should have cyber security areas. So each of these bullet points gives you 0 or 4 points. Awareness and adoption of technology for service delivery. Now this is another aspect, which means if you are doing an audit, do you have an electronic audit documentation tool? Which means your audit files are not manual, it's electronic. Do you have data automation or analytic tools that gets used? If you have, then it's a yes, 12 points. If you don't have it, it's 0 points. Again, there's no gray area. I can't say I use manual files for small clients, I use electronic files for large clients. No. Either you're using electronic or you're not using electronic. Last point on practice management, we're looking at overall operations. What's your process of revenue, budgeting, and pricing? Here again, we had discussed earlier that if your actual time cost has gone up, how do you actually monitor that for a fee increase? More importantly, as a firm, you should have set up your minimum fee aspects. And these may or may not be linked to the minimum fee the institute has given. Of course, it cannot be lower than the institute's minimum fee, but you could have a minimum fee which is higher, depending on how your cost and time goes in, your investment in technology and quality goes in. So you should be analyzing based on client-wise revenue. Again, this is based on code of ethics that no single client should constitute a significant portion of revenues. Previously it was 40%, now it is brought down to 15%. The fee and scope should not infringe upon quality of work. As we spoke again, if the fee comes down below cost, the first thing to get cut is audit quality. So that should not happen. We should be able to ensure quality is being maintained. Adherence to minimum scale of fees, we just spoke about that, whether you have that minimum fee and being followed or no. And if there are instances where engagements are being done at the lower than the minimum fee, if there are more than 50%, then you get only 4 points, less than 50% or no, it will come up to 2 points. So depending on how you are calculating this. With that, we cover up on practice management. Next one, it gets into human resource, and this is where it starts getting unique, because here the extent of requirement on AQMM is factoring in a lot of the complaints that come in. Now when you're looking at overall resource planning and monitoring, this again goes back to capacity planning we spoke about earlier. Employee training and development, which means other than monitoring that all your staff are attending the necessary CPE credit related training, what other additional specialized training does each firm have? How do you ensure all staff have adhered and complied with the training policy? Falls under this. Resource turnover, compensation management. So there are a lot of factors you're looking at. How do you analyze attrition that's happening? How are you ensuring that the salaries that you're paying is in line with what the market requirements are? Qualification, skill set of employees, and where I need to use experts, whether these are being tracked and monitored. Last one that also has there is, how do you evaluate the performance of your staff? So there should be a clear-cut policy and process on setting up KPIs and evaluation of these KPIs. Now after performance management's 280 points, this is the next largest with 240 points. So when you look at HR management, now again, as I said, it's all very simple checklist-oriented process. It's all yes or no only. Do you have a resource planning per engagement based on skill and experience required? Which means if I'm doing an audit of an NBFC, other than ensuring that I have a partner with sufficient experience in auditing NBFC, do I have a manager who also has certain experience on NBFCs? Do I identify field seniors who have at least done one NBFC, and if not, have any done internal training the firm may have on audit of banking and NBFCs, have they done that training to have some knowledge of the jargons and processes followed? And therefore, yes, this is the team that I've selected. Again, this became unique because when I was speaking to some other firms, common practice may not necessarily be that much of effort on team planning. Some partner once said, I just step out of my cabin, I see which staff is available on the floor. I said, okay, you're free. Okay, go to this client. They need extra staff. And that's how the staffing happens. Based on who is available at that point in time to start it. Whereas if you look at what is required under the Code of Ethics or even from the auditing standard, it requires an auditor to plan that they have the right team for the right job. Unfortunately, for whatever reasons, you don't get time to sit and do that, because if you have two engagements going on at the same time, you can't have the same person working on both. One of them gets the right person, the other one you have to make do with what you have. But here again, I start looking at it, saying how do you actually choose who's on the engagement team? Tools used for resource allocation, which means do you have, when we spoke earlier on project management being done on use of technology. Now whether the technology being used for resource allocation, which means which staff is assigned on which project. Not only is the firm able to view that, even the staff is able to see which engagement they are on, from what period to what period. Tracking their activity and productivity, that is through these timesheets. Minimum ration of partner to manager, manager to staff. Which means there has to be a triangle that is maintained. And therefore, how many managers can a partner supervise? And if there are more managers under that partner, you will be concerned as to whether quality is being maintained. How many staff can there be under each manager? And therefore, if you have more staff than that, is the manager therefore able to manage the quality of work being done by those staff? So that triangle has to get established by the firm. Monitoring utilization, realization rate per employee. So if I go back and say there's a total of 40-hour week, 8 hours a day, 5 days a week if I'm working, therefore I have 2080 hours in a year. I have holidays that come in, which is standard 12 to 13 days of holidays. I have leave that I provide to my staff, about 20 to 23 days of leave. So if I remove that into 8 hours, how much of a leave that gives? I may end up with something like 1800 hours of billable time. Out of 1800 hours, I have to ensure training, that all staff have been attending that. I have to ensure my staff is attending the CPE credits at the institute, which again means because these are, some are held of course after office hours at 6 to 8, but some are held like this during the day if I'm working and things like that. So how do we monitor that, and then what time is actually billable overall, and what is therefore my standard utilization of the staff. So you have to monitor that and compare whether actual utilization is happening, and there should be decisive techniques on what the firm is doing based on lower utilization, excess utilization. Because there could be staff who is always consistently working not 40 hours a week, 80 hours a week. They are working on Saturdays, they are working on Sundays, they come in the morning 9:30, leave at 12 o'clock in the night. Firm has to take action and say if my utilization is coming above 100%, whereas my required utilization is supposed to be 75%. Because out of 2080 hours, so many days of leave is there. But somebody is booking not 2080, they are booking 2100 hours of billable time. Clearly overutilization. The firm should have a process of how do they monitor and act upon it. Document resource plan per engagement and file for references, which means when I open an audit file, each engagement file should have a resource planning budget. Which team am I planning? How much time will each member of the team spend? Which area will they spend time on? That budget plan should be within the file. Next, when we go to another section, it will ask you not only budget and plan, actual against that should also be in the file, but that's in a separate section. Employee training and development, about 44 points goes in. First one is on the existence of a policy. Do you have a clear-cut training policy and how many hours of training each member should have? And this is one minimum, of course, you'll have to maintain the CPE requirements in case of qualified staff. But you may also have a lot of articles. Just because the article does not mean they don't need training, they should also be undergoing training. So you should have a clear-cut training plan and policy. Number of professional development hours or days per employee. Now, if there is more than 60 hours, it is required for junior level. They have to have more than 60 hours. Mid-level, which is your manager level, should have between 30 to 60 hours of training. Partners should have more than 30. So you cannot be less than 30 hours. Now, if you look at it, 30 hours roughly meets your minimum CP credit requirements that is there. So again, when you look at this nature of training, there should be at least 2 hours of training that takes place, or 2 days per employee that happens, on general training. When I say general, there should be regular training that happens on various topics, and 6 on special. So you should have some special training that happens. So the scoring goes is that way. You can get a total of 8 points for each level, giving you a total of 24 points, for which you have to maintain A on the hours. How much of training is on general, how much of is on specific. So if you do special training, you do general training, you make sure the hours of training that is getting covered for junior exceeds 60 hours, then you will get total 8 points for junior level. Again, you have special trainings that get conducted, you have general trainings that get conducted. Time spent on managers is more than 30 hours, 30 to 60 is getting spent, you get another 8 points on that. Partners also are undergoing training, which means just because you are qualified CA with years of experience and the partner does not exempt you from training. You have to attend training. And again, it should be on general topics and special topics, both of them come in, and you put in more than 30 hours of training per year, then you get another 8 points, a total of 24 points therefore is possible under this. Employees equipped with technology skill sets, which means when you're talking about the special training, your special training topics that can be covered is on artificial intelligence, blockchain. Fortunately now blockchain and all is getting covered as part of the CA curriculum under the new syllabus as we go forward. So hopefully the new CAs you recruit 3 years down the line will already be having these skill sets. But till then, the current people that you have on your staff will require special training on these topics. And that has to be part of your training plan. So you cover AI, blockchain, data analytics. These have to be sponsored by the firm, either by you conducting the training internally, or if there's something being conducted by the institute, you pay for the participation of your staff, not that the staff pay on their own and go. And how these training, once your staff has attended, how are these getting applied on the engagement? Which means you can't have a staff attending a session, which could be 8 hours or 24 hours institute conducted or externally conducted on data analytics. You spend on that staff comes back and no data analytics done on any of your engagements, not acceptable. So they're saying if you set your team out for this training on data analytics, you should be able to demonstrate how this training has come back and applied on your engagements. Only if you are doing that, you get 8 points. But of course, the only reason they put here is the application. They will be evaluating it, not for all engagements. They have restricted to listed NPACs. Because at the end of the day, AQMM applies only to listed NPACs. Existence of performance management culture with rewards for high performance, high levels of quality, ethics, etc. Which means, in addition to having an employee evaluation process, which we'll cover as part of the KPI evaluation, there should be a reward process. So if somebody has done a good job, how do you give them? Do you put them up as employee of the week, employee of the month? Do you give cash rewards? Does the partner take that person out for dinner or lunch? Something like that. There should be a mechanism of rewarding for high achievement. So do you have that? Again, not just policy, you should be able to demonstrate how these are actually applied. So that yes or no gives you a 4 or 0 points. Then you get into resource turnover and compensation management. So when I'm looking at this, again, how do you monitor your attrition? What do you do to evaluate the composition is okay that is coming in, number of people on the engagement, number of article assistants, paid assistants, managers is appropriate to what is required. How do you monitor your turnover? What do you define as attrition? Have you had exit meetings with the people leaving to identify causes for attrition? What are the remedial activities taken place by the firm for those attrition causes so that the same causes do not repeat? And whether you do this for and revise whether the reason for attrition is happening based on A, junior people who came in leaving immediately after a short time of probation because they didn't know what audit was, they realized chose not to fine, or is the attrition happening for the staff reporting on a specific engagement and therefore the attrition level on that engagement is high, or is it when all the people working with specific manager or partner is where the attrition is happening? This analysis is also required to be done. And what remedial measure firm takes to improve or either reduce on its attrition rate and improve on its retention. Ensuring that all statutory contribution, be it health insurance or other benefits, are actually made available to all staff and partners. Evaluate different engagements, which one has a higher, as I said, a higher turnover, attrition that's happening. So all of this is a huge focus that is being paid on compensation management. Additional things that we look at is whether the compensation is actually based on performance, which means a highly performing individual is getting paid a better salary than a low performing individual, and therefore not everybody is getting paid the same. So every year, first year all of them may be at the same level of salary, but second year onwards there has to be differentiation happening based on performance. So again, you should have a clear-cut policy on how increments will be given based on high performing, low performing. Access and use of technology infrastructure for better day-to-day work and facilitating remote working policies. Which means A, you should have internet access provided to all staff, everybody should be having access to laptops or desktops both at office and home. You should be evaluate the need of a VPN to access your server and client confidential information. Whether these have been provided, again going back when I'm talking about access of technology, we had spoken earlier of availability of email addresses, and therefore access is permitted only to those with a valid email address pertaining to your corporate account. So all of that falls under use and access of technology. Coaching and mentoring programs, especially for women employees in the process to enhance diversity of audit leaders in the profession. Which means again, when we're looking at what this means, and I was looking at the trend in some of the firms, it was noted that in very few cases there were women partners. In most cases, women moved out of the audit profession at a manager, senior manager level after having put anything between 8 to 10 years of work. Mostly because that's the time focus moves from clients to children. They are able to manage profession and marriage as far as only the spouse or the other family. But as the children start growing up, a lot of other issues start coming in. They're not able to spend that much hours at work, and therefore prefer to move out of audit, either get into accounting or industry jobs, which has a very fixed number of hours and periods that come in. And therefore here one of the requirements is what is the firm doing to improve retention, especially around women employees to bring in diversity. That is, if there are staff within you who are married, having children, are you providing flexible working hours? How is it you are managing, ensuring you are able to retain them and able to continue providing whatever you are doing? Policies providing staff with time to rejuvenate, which means providing leave opportunities, leave days is not just a policy. The firm should have a process of mandating how employees actually utilize leave. You could have a large engagement that you are doing where staff has spent considerable amount of time. After that audit is over, they will not move on to the next audit. They will be forcibly sent on leave to make sure they take rest, get time, rejuvenate and come back on the next engagement. So not only policy, the firm should demonstrate how are they actually implementing this. Which again goes back whether timesheet process is there or no, and how have you identified where overwork is happening. Focus policies and support on staff well-being, engagement and communication. Again, you should have proper policies, which should be HR centric. What are the staff benefit policies that are there? How often do leadership in the firm interact with, if you have a large networked office, you have offices in 3 or 4 locations. Every firm will have a managing partner. How often does the managing partner go to all these locations? How often does he or she interact with all the staff? Do you have town halls where the staff get a chance to interact with the managing partner? So these are some of the facts we'll be looking at as to how these interactions and policies are actually put in place. Mechanism to listen to people, taking views and suggestions. So is there a Dropbox available at all the firms for employees to give their feedback, suggestions? Whether it is named or anonymous that they provided, doesn't matter. There should be a process of taking this feedback, evaluating it, and coming back with an action taken report. Saying these are the points we received this week or this month. This is the following steps we've taken to address these points. Which one will be done this week, which one will be done next week. All of that is communicated back to the staff. Now when you talk about the earlier section on well-being as well, there was one comment that came in saying, do we need to have a number that staff can call on? Because there is a high trend of mental anguish that sometimes people go through. Because well-being is not physical well-being, it's mental well-being. The answer is yes. Both as part of a policy processes, you should have a POSH policy, which is prevention of sexual harassment, and there should be a call-in number for people to complain on any item of POSH. Similarly, there should be call-in number for people who are getting impacted by anxiety getting impacted by depression, because there could be a staff member that continuously for 1 year, 2 years has been claimed as below performance. That person could go under depression. And therefore, from a well-being perspective, you should have a helpline number that people facing depression or anxiety can call in for that well-being. So well-being here is not just physical, it covers mental well-being as well. So when you're looking at this, yes, no, whether that policy also exists and do you have such a process will also be looked at. Standards on recruiting people. Again, there should be standard methodology of recruitment. It cannot be based on resume received from the CFO of my client and therefore recruited. That cannot be the basis. What kind of assessment will it be done? How do I do a technology compliant assessment? Whether he's aware of our auditing standards, accounting standards, does he have relevant experience? One is from that technical expertise, other ones could be compatibility. This is the kind of person that this firm can take on. Will our culture match? Culture is the way you practice. Now will that person's culture and the firm culture merge? If not, you don't want to take that person. So that evaluation also comes in when I'm looking at recruiters. Looking at qualification skill set of employees and use of experts. Again, we'll be speaking, one of the significant gaps that come in is a gap pertaining to technology. There's an evolution gap. Things around us are changing, but auditing standards still remain auditing standards applied in 2010. Of course, there's a revision in 315 that is currently proposed with other revisions and other standards arising from it. And that is a significant revision, but other than that, making sure you have the necessary skill set. Do you have somebody in your team who's an IT specialist? Is there somebody in your team who's a valuation specialist? That may be required. So do you have the required specialists? If not, have you in advance identified who are the experts? Because the key matter when you employ experts which are external to the firm is confirming on their capability, competency, objectivity. These are terms that is used in the standard. Which means A, they have the training, necessary skill sets. If they have any professional certifications to be maintained, registration to be maintained, they have active registrations. They have a concept of maintaining independence, they have a concept of maintaining confidentiality, they have a good process of recruitment, they ensure constant training within that. All those assessments need to be carried out. So have you done this and identified therefore which firm will you appoint for all your IT work? Have you identified which firm you will appoint for all your valuation related work, because you do not have the skill sets. So it cannot be that on an engagement specific basis I will try and search for somebody. Now there are a lot of cases you also take a lot of legal opinions, maybe on certain positions. It could be on contingent liability evaluation. Have you identified a legal firm that you will constantly work with? More importantly, which would be the partner in the firm you will work with? Because the evaluation of competency cannot be competency of the firm, it has to be the competency of the partner whom you are interacting with. Professional with necessary post-qualification certifications. Now how many people do you have who have got CISA, DISA or IP related experience or certification? And IS related, of course, it's been restricted to when you're looking at listed entities, banks, like that. So this assessment, whether you have IS related staff, will not apply if none of your engagements require an IS specialist. But in these days, especially the audit report also looking at you commenting on the existence of audit trail, which is not applicable only to listed entities but all entities, and 99.99% companies now going into minimum tally and nobody maintaining manual books of account. Very difficult to say I will not require any specialist. So in all probability involvement of specialist will be there. Degree of involvement may vary depending on the accounting platform. How many members do you have with specializations, whether these could be on newer areas, global changes happening, new indices coming in. Do you have people with expertise, let's say financial instruments and derivatives? Though it's an existing Indian accounting standard 109 covers that, but there's a lot of uniqueness involved. So maybe not just because you're a CA, you did a IFRS certification course in the institute, doesn't make you a specialist on derivatives and financial instruments. So how do you know how to identify an embedded derivative in a contract? Understanding what an embedded derivative is also complicated when you read the standard, because it's very open-ended. So you may need internal specialists who have special training purely on understanding financial derivatives. So do you have such people? Do you have people who understand the revisions that are happening, let's say on IFRS? Because you may also have IFRS reporting in addition to Ind AS. So does these people know difference between IFRS and Ind AS? Do they have any specific accreditations that are required? Now all these factors, if you have less than 30% of such staff, you get 4 points. If you have more than 50% of such staff, you can get up to 12 points. Which means if you have 0, that's less than 30, you'll get minimum 4 points even if you don't have anybody, because they don't have a case of nil in this table. Now last one on this matter is on KPIs, performance evaluation. So one, they said we should have a clear-cut policies on how do you develop KPIs, which means KPIs will be at all levels within the firm, including the partners. And the KPI should be individual specific, it cannot be overall, at least for the partners, but rest of the staff, based on designation level, you can establish KPIs. Say for managers, how often do they interact with their teams? How often do they review? What should be the review time between when the team gives in a work paper to the feedback the manager gives back on the work paper? So all of these could be KPIs on performance. It could be KPIs on how often they attend the trainings that are required, how often they are ensuring compliance with ethics and independence requirements, all of that. So there should be various policies on KPIs that are there and how a performance evaluation is done. There should be a method of constant evaluation, whether you do it quarterly, half yearly or only annually. The choice is there of the firm and the size of operations. But there should be a method of measuring this, which means the KPIs should not be only qualitative, they should be possible to do quantitative measurement. So method of measuring and how do you evaluate it to say whether complied with or not. Frequency of evaluation, as I said, quarterly, half yearly, monthly, annually, that's a choice the firm will have to make and it has to form part of your policy. And evaluate engagement partners, which means what would be the salary, profit share of the partner indirectly will get impacted by the assessment that you do of their performance. So this process should be there, and based on each performance process, you get 0 or 8 to points in total, working out to a 32-point category. So this overall covers your human resource management. Then the final set that is looked at and the least scoring mechanism here is on the practice management. But there again, if you based on which level you want to be, you'll have to get a minimum of 50% if not 75% of this scoring. Now here again you see that infrastructure is the one with the significant amount of scoring, we'll get to that. But when you're looking at practice management, a lot of focus is also on A, are you part of a network? Are you part of an association? Do you have offices in more than one city or not? How many years of mix do you have on people? Do I have partners who are less than 5 years experience, partners with more than 5 years experience? What is the overall experience that you have? So all these factors go on about evaluating how you actually run your operations. So balanced mix of new and experienced. Average partner experience is less than 5 years, you get 0 points. If partner has 5 to 10 years, you get 4. If the partners have more than 10 years experience, you get 8. Compliance of professional independence and conflict of interest requirements as per ICAI code and compliance with Companies Act. If you have this whole process of setting up, again, if you looked at the earlier, it has to be technologically run, so there should be a technology application through which you're ensuring compliance. And therefore that will either give you 8 or 0. Existence of a whistleblower policy. Key aspect here is, yes, we've read in SEBI LODR for our listed companies to have a whistleblower mechanism. The CARO amendment requires you to evaluate the outcome of whistleblower mechanism, but these are all for your clients. Under AQMM as an audit firm also you'll have to establish a whistleblower policy, which also then means you have to identify somebody as the ombudsman of the whistleblower policy. Now the question is, can it be an audit partner? If it's an audit partner who is the ombudsman of whistleblower policy, the team can never complain about him or her, but the moment we just ignore that item itself. So it has to be somebody independent, that is, somebody who is not signing off on financial statements or any other audit. So the ombudsman has to be an individual not responsible for execution, and therefore can take cognizance of the complaint and take action against it. Which means, does that mean you now have to identify how companies have a chief risk officer who may be a partner but not an audit partner? Next one is on infrastructure. Again, as I mentioned, when we start talking about whether you're part of network or association, so they're looking at how many offices do you have across the country. If you have less than 3 offices, the points are 2. If you have more than 15 offices, you get 8 points, which means at least in 15 cities you should be having a presence. Now the only way to do, and as we spoke in the first slide that I brought in, AQMM is there because the institute is looking at it as a capacity building measure. So if you want to get more points here, you have to build capacity. You have to start working either as a network or an association, wherein you get into specific terms of MOU with all the firms in those cities, and therefore be able to claim that you are there in more than 15 cities. So get 8 points here. Branch level activities, whether it's accounting, payroll, processing, invoicing. If you have various branches, whether you're centralized or not centralized. So based on that also you get scoring. If it's centralized, it's 8. If it's decentralized, it's 4. The reason for centralizing being higher is even if you have branches, associates and network forms across, the moment you centralize it, you are actually working as one. When you are decentralized, you're not necessarily working as one, which is why decentralized gets you a lower score. Physical, logical security. This again we had covered initially when we covered on technology access in the first part of performance management, but here they specified physical, logical security. Now, those of you who have done IT audits, if anyone has done, you will understand that's also one of the aspects that is looked at from a ITGC or IT General Computer Controls. Physical restrictions means that there is either a lock and key or access card restriction on who can enter the server room. Logical access is there is a specific network user ID and password which is constantly changing and therefore cannot be shared or used by anybody even if they become aware of such password. Adequate use of data analytical tools and IT infrastructure for relevant assignments, which means the institute did have a publication on use of computer-aided audit techniques. How can they be utilized? The new 315, which is currently proposed pending revision, talks about data analytics. So these will start becoming mandatory and application for audits, and therefore companies or firms will have to start investing on data analytical tools. Whether you use something like Power BI, which is available with Microsoft, you use something like Tableau, which is a little more visualization based, you use further Excel, programs for analytics, individual choice. But yes, it should be there and it should be made available to your staff for actual use. Adequate infrastructure for remote working. Again, this is linked with your HR when you spoke on infrastructure being available for remote working, which means if somebody wants to work from home. And this will also get linked with when you looked at the diversity as to what benefits are you providing to women employees, where you give flexible hours or other things. Do you have what it requires for them to work from home if necessary? So all those things will get linked. So there's work from home as a policy coming in practice management. There was a facilities and services being rendered to women employees that was there in HR, and now we come into security. Here we are again talking about use of DA tools being coming in and infrastructure being provided. So when you start looking at all of these three together, you can't have no in any one of them. It has to be yes in all or no in all. So you have to make sure that this linking is ensured as far as consistency is concerned. Practice credentials, again there are some negative scoring is there. Of course, I could not understand why the institute actually put this into AQMM, because there are certain aspects which says, peer review certified, yes, that's a clear case because this is applicable to all listed companies. Auditors are listed companies, so peer review is anyway mandatory, so that coming in is fine. But the next one says empanelment with RBI and CA. Not all firms may have chosen to be empaneled, and therefore I may not have, so I may never be able to get this 8 points. Because empanelment requires certain experience, certain other aspects too. So if you're not empaneled, you will get 0 points. If you are empaneled, you get 8 points. So advisory by CA office to not allot work due to unsatisfactory performance can give you negative points. If you don't have any negative comment, it's 0 points. And any regulatory authority who has evaluated your performance resulting in debarment or blacklisting. This is of course NFRA basically looking at it, or the institute which looks at it. If there is such a case, then negative 10 points or 0. Negative assessments on reports of the QRB, negative 5 or 0. Any case of professional misconduct, you get a negative 5 or 0. So this is a key area where they looked at as to whether there have been any questions or concerns regarding your independence or quality that has been raised, and if so, that will give you a negative marking depending on the nature and the party who has raised the concern. So why is all this? This looks very tedious. Is this actually something that is required? Can it be complied with by Indian firms? If you actually look at, other than the last slide where the mandatory empanelment gave you an 8 points or 0, everything else has been kind of Indianized and is actually practically possible for firms. They are not as stringent as what is required in some of the other geographies, and to that extent, it's not something that the ICA has put out which is impossible to be done. It is highly possible to be done. Firms may need to start considering that, we spoke of the vision and mission plan. The vision and mission plan is forward-looking both on quality and ethics, and therefore, firm when it does a self-evaluation to be, let's say, an L1, L2, or L3. The vision mission statement should be, how do I move on to the next level? So the vision will be move on to the next level, mission will be, how do I get there, what do I need to do? So there should be clear-cut policies that you put in place. There is a recent white paper of objective data discussed on joint audits. So joint audits do become mandatory. Firms will have to start demonstrating that they are up to the mark to make themselves eligible to submit proposals to the audit committee saying, yes, I am available for joint audit. Because one of the things that, when you're speaking to the big four audit firms, I have not spoken to GTPDO so much, but at least among the big four, one of my other partners was having a discussion with them and what their points are, why so much objections on joint audits. Most of the MNC firms, not just the four, all the other MNC firms have to comply mandatorily with international standards in addition to complying with local standards. India has substantially converged with international standards, including those that are coming up with proposed 315 amendment, comparable amendments to 200 and all that is happening. It will be converged with international standards except for two standards. There is an auditing standard 299 on joint audits, which is very particular only to India. No other geography in the world has that standard. Other one is SA 600, that is relying on the work of other auditors. These are the only two standards which have not been put in line with international standards. Of course, the institute has various reasons why it has not been done, and that's one of the reasons why the large firms are hesitant. Because A, under these standards, there is a clear differentiation of work to be done. 2, one firm has no access to the work papers of the other firm. Whereas in the global scenarios, there is no clear demarcation. For example, if I am one joint auditor, you are the other joint auditor, I may say I will do all the assets. You will be doing all the liabilities, that is debits and credits. But the way it gets structured in a joint audit is, when my team does the assets, you will review the work. When your team does the liabilities, I will review the work. So when we signed off on a joint report, you know what you've done in liabilities because you did that, and you know what I've done in assets because you reviewed my work. And therefore, when you sign off a balance sheet, you know both assets and liabilities. Unlike here, where a joint audit specifically demarks it, therefore you will know liabilities, I will know assets. I will rely that you have done correctly, you will rely that I have done correctly. Both of us don't know what each other has done. Though we might have covered an overall plan, how things to be done. The process you follow on materiality, the process you follow on your sampling, each firm does it differently. Whereas here when you start sharing the work papers and review, feedback comes from each other, therefore both firms become comfortable. Now that is the global standard. India, this is not available, so you end up relying. And that is where the discomfort comes, because the large firm is saying, I have no idea what the other firm is doing. Whether they selected the correct sample. How did they conclude? If there is a deviation in one sample selected, how did they conclude that the deviation is acceptable? Because they should have brought it up to me, but if they concluded it is acceptable, they may not have brought it up. And therefore I do not know if something was there. And therefore I am signing off on that risk. And they were very hesitant to take the risk. And therefore they are not for joint audit. But at the same time they came back and said that if there are firms who meet a certain level of quality, who have not hesitation to be able to share their work papers with us if required, we are ready to work with them. To the point that they will actually suggest those firm names to the audit committee when joint audit comes up. Which means if the firms are able to demonstrate that they are at a certain level of quality, the firms need not go to the market to find work. As long as they are able to demonstrate to some of the large firms, the big 6 firms, those big 6 will get work for you once joint audit comes up. Because they will prefer to work with somebody they trust who is meeting quality rather than somebody they do not. So, building up on quality becomes very key. And more importantly, audit committees and independent directors will start looking at specifically who their auditors are, which means they would want feedback on both the current auditors and the new auditor coming in, are there L3 or L4s. and there will be restrictions saying they will only appoint firms, which means L4, which is above 75% compliant with all the AQMM requirements. Because they are also responsible to ensure the right person is selected for as auditor, which is a requirement under SEBI LODR when it comes under roles and responsibilities of an audit committee. So right now it's just based on RFPs and proposals, and this information, though maintained not to be shared publicly by the firm, can be intimated as per the requirements that's given in a proposal that you're submitting specific to a company, or along with a peer review certificate, each will make this public information. So again, right now focus is on audit firms providing audit services to listed entities, banks and insurance companies. But there's already talked by the institute that should this extend to large non-public companies as well, because a lot of investment sits there. They could have venture capitalist investment houses investing. There could be cases of banks giving huge loans, especially after what was discussed on Byju's. Institute is contemplating. Should they extend that the firms doing audits of these companies should also be subject to AQMM and PLA. Now, if that does come in, then you can't say, AQMM doesn't apply to me, I do not do listed company audits, or banks may no longer hold. This will also be an appropriate time. I think the institute has also been focusing, and very recently they did an amendment to the network rules also that were existing, hoping that more and more firms will come through and start forming networks. Unfortunately, the amount of firms doing it is very dismal. But this, when you start looking at the requirements here, having to have that many offices, amount of effort that has to go in building up your SQC manuals, audit manuals, the cost that is involved, it's better to be shared than be incurred by any one firm. So if you start forming a network, all of you will use only one manual. It's not that each firm will develop a different manual, which means all of you can put your resources and funds together to develop one manual. And therefore, the need for networks will actually go up. So we're looking at this is probably the right time, though it may take some time to come in. What Modi ji had expected or hoped when he said it a few years back, just before the rotations and all came in 2017, that why is everybody talking about the big four firms working out of India, or concerned with the big four getting access to the Indian market? Why aren't there any Indian firms who are growing large enough to actually compete with these big four, such that there is a big eight globally, out of which four firms are from India? The reason that is not there is because firms are not ready to come together and work together. Everybody wants to do work on their own. Now, with these compliance requirements coming in, it's going to be very not cost effective to do it on your own. It's going to be cost effective only if you start coming together. And we are hoping, therefore, that the capacity building intention with which the institute came out with this AQMM model will actually start functioning by developing more and more networks across in India, and hopefully, if not large four firms from India, at least one large firm comes out of India. So with that, I end my discussion on AQMM. If there are any questions, anything that you want to discuss, I am open for that.
Members, the word quality in AQMM indicates that audit quality is not a destination but a journey. Members in practice or in industry need to gather all the learnings and experiences on a year-on-year basis and improve the quality of their audit, and brings in maturity. Members affirm with quality as a service and bringing in all their learnings together and bring it to a common platform for the members at large. Team True and Fair is doing it as service. A big round of applause for the fantastic presentation by Jaideep sir. Thank you, sir, for your time and efforts to bring your experience to the audience here. On behalf of members present here and all the managing committee members of Bangalore branch of ICI, we would like to hand over a memento as a token of gratitude and respect. Can I request CA Jaideep sir to come out to dais and then do the honors. Thank you, sir. Thank you, Smith, sir. Thank you, one and all. Have a sparkling Saturday.